Hello everybody, and welcome to this video entitled The Most Undervalued Growth Stock. This is a video that I do every Friday on the channel where I update the valuation of every stock in my coverage universe, mostly stocks that I've covered on the channel. And one thing you need to know when you read this is that I do it very differently than a lot of other channels and a lot of traditional finance, in that the focus on my channel is growth stocks. I invest in growth stocks, especially hyper growth stock. For example, most people would consider Amazon a growth stock. I don't cover Amazon. Amazon is a growth stock, not a hyper growth stock. I cover stocks that grow at least at 30% revenue growth. Over the next 4 quarters, I want at least 30% of revenue growth. And the reason why I do that is because I want to double monetary inflation, which I estimate to be at 15%. In order to double that, I need 30%. Because if money supply grows at 15%, a company that grows at 15% in nominal terms is not growing in real terms. It's only staying afloat. It's only catching up with a new amount of money supply that's being put out there. A company needs to double the new money supply in order to actually have real growth. And that's why on this channel I focus on real growth. And that's why when you hear me say things like I'm disappointed by, say, 25% growth, revenue growth, well, yeah, I'm very disappointed by that, because that only means it's 10% revenue growth in real terms. That's the principle of hyper growth investing. At least that's the focus on this channel. There's other things that I focus on the channel. One of the things that I do a little differently than a lot of other people is I focus on enterprise value, because enterprise value takes debt out of the market cap, and I think it's more fair. You have a lot of companies that have a lot of debt. That debt oftentimes is not reflected through market cap, and I use EV, enterprise value. And lastly, the metric, right? The metric that you divide the price with, that I use on this channel, is gross profit. Why do I use gross profit and not net profit, or even worse, earnings? Why do I use gross profit? Because I believe gross profit are the most relevant for my style of investing. If I'm going to buy a stock that has to grow 30% a year for 10 to 15 years, that can mostly only happen for a company, for a product that has not been adopted yet, right? McDonald's, Walmart, they're not going to grow at 30% a year for 10 years. It's impossible, right? Established companies are not going to do that. It's new companies that are going to do that. Companies that are typically less understood, that are typically less consensus, have less consensus, that are less accepted, more controversial in a way. And really, a relevant chart to my style of investing is the product life cycle, or the product adoption curve, right? And the whole idea is you try to get into a stock when you have early signs of product adoption or service adoption, and that's typically 5%, plus or minus 1% of the general population adopting a product. That's when you have a sign that you have the beginning of an S-curve, And really, when that S-curve starts manifesting itself, you get a little bit of exponentiality, and it goes straight up. And the style of my investing is really to invest in a company that has a product at a time where most people disagree with that product, where most people don't do the research on the product, like electric cars. I think electric cars are getting more and more accepted, but you still have a majority of the population who do not get electric cars. And so that's a sign that you're investing in a company that's very, very, very early, right? And you're going to ride all of that product adoption. And the goal of this style of investing is that once a company becomes mainstream, once everybody has a product, you try to get out, you try to sell, right? A good example of this adoption would be Apple. People sometimes joke about Apple and they call it the iPhone company. So if you were to think Apple is the iPhone company, a good time to invest in Apple would have been between 2010 2010 and 2012. Really, if you had invested before 2010, you would have been a visionary. But really, 2010 to 2012 is when you wanted to buy Apple. And really, selling Apple right now, I think, makes sense because just about, it's very heavily, very widely adopted, at least in the West. I mean, if you go in the US, 1% out of 2 has an iPhone. So you're right there in the adoption. You're in the late majority, or at least right there, like end of early majority, late majority. So that would make sense to get rid of a stock like Apple, per my style of investing, per my view of investing. I try to invest in these megatrends that are oftentimes innovation-driven, growth-driven, sometimes culturally driven, but nonetheless they are megatrend. So let me begin with my spreadsheet and tell you which stocks are the cheapest and which stocks are the most expensive. The cheapest stocks in my universe right now are HIMS, StoneCo, and Lovesac, a company that makes bean bags. Really briefly, why am I saying that they are the cheapest? You can see on my metric, enterprise value, over trailing 12-month gross profit, over revenue growth, I have numbers that are very low for these stocks, like a 0.06, 0.08, and 0.08. What does that mean? That number describes to me how cheap is that growth. How inexpensive is the growth? If you're familiar with the PEG ratio from Peter Lynch, you'll see a similarity, right? Except I don't use stock price, I use EV, right? I don't use earnings, I use gross profit. I don't use earnings growth, I use revenue growth. But aside from that, that's a derivative of the formula. And what that formula answers is, how cheap is that growth? How cheap are you paying for each percentage point of growth? And when you look at this spreadsheet, you can see that HIMS, StoneCo, and Love is where you're really not paying up at all for that growth. That growth is very, very, very inexpensive. And you can see this through other metrics. Like if you look at price to sales, for example, you would clearly see that these stocks are dirt cheap. You obviously can't use a metric like price to earnings ratio. It's not possible to use price to earnings ratio when a company is this early on, when a company is investing. You can't use PE. So anyways, that's the main metric that I'm going to use to rank the stocks in my universe. What are the most expensive stocks? What are some super growth stocks, very high growth stories, amazing companies that are so expensive right now? Well, one of them is Shopify. One of them is the Trade Desk, and one of them is NVIDIA. I didn't highlight the Trade Desk, but the Trade Desk just joined the club of a very expensive growth. You're paying more than a 1, and more than a 1 on my metric for NVIDIA's for Shopify growth and the Trade Desk growth. You're paying above a 1, which is super high. I mean, it's more than 1 order of magnitude. Perhaps if you talk about NVIDIA, 2 orders of magnitude, right, IMS to NVIDIA, more expensive for that growth. You're really paying much for that growth. Let's take an example of NVIDIA, which has been overvalued in my spreadsheet for months, by the way, which is why I've sold the stock early on. Too early, maybe, likely. Only the future will tell. It's a lesson, but at a 5.1, it's so expensive. You look at NVIDIA at a 5.1 for each percentage point of growth. NVIDIA is almost 100 times more expensive than HIMS, almost 2 orders of magnitude. So you have stocks. I mean, really, Mr. Market is all over the place. Manic, depressive, granting crazy valuations for some growth stocks and granting nothing to other stocks. Nonetheless, what matters is that underlying revenue growth. At least that's what I focus on the stock. Keep in mind, as a last reminder, the title of a spreadsheet is most undervalued. The most undervalued. It's not the best stocks. Right? A stock can remain overvalued for a very long time. You can buy an overvalued stock and it stays overvalued for 10 years, 15 years. It's possible. That's not the goal of this spreadsheet. So really briefly, because I am still on a vacation, I don't have much time, but really briefly, what are some of my thoughts on each of the mega trends in the sector? As a reminder, I'm taping this video on Thursday. It's going to be released Friday, so you may see a one-day lag in the enterprise value numbers, so just so that you don't be surprised. Let's get started. Energy revolution stocks. Energy underlies every single thing we do in the economy. Every single business can be summarized to an input of energy. Energy is getting revolutionized. Oil, gas are slowly getting phased out and they're getting replaced by electric-based technologies. I believe solar is going to be a winner. I have a lot of evidence to back my thoughts about solar as the cheapest source of energy. You may have people who believe in nuclear and wind, and that's a debate. But the point is, energy is going electric. It's moving away from oil and gas, and it's going electric. And how can you play that? Well, Tesla is an expensive stock. It's an expensive company. There's no denying it right now. Got much more expensive recently, but it is the leader, I believe, in the energy revolution stock. Right? They're known for their electric cars, and everybody talks about their electric cars, but it's much more than that, right? It's the replacement of a gas station with a charger network. It's heavy-duty transportation with the trucks. If you saw the investor presentation, they started talking about planes and boats and AC units and tons of other things. They're also getting into mega packs. They're getting into solar. There's so much going on Tesla. And I'm not sure if there's any channel on Tesla out there on YouTube. I don't think I've seen any, but if you know of any channel on Tesla on YouTube, I'm joking. You can probably go see and you know how big of a story is. Tesla is a big company. It is the Standard Oil of our era, in my view, and it's actually my number one position in the portfolio. Moving on, you have Enphase. Enphase is focused on microinverters. Most of their business is on microinverters. If one invests in Enphase, one has to believe that the future of microinverters are these tiny boxes that you put behind each solar panels that converts DC current to AC current on the spot within 1 foot of the solar panel. That's what a microinverter is. And there's still a lot of blurriness about that. A lot of people still do not see or understand or even believe in microinverters, because really the way of doing inverting system for decades has been string inverters, but string inverters don't work as well. And if you look at the competition of Enphase, like SolarEdge, it's a string inverter. And they will tell you that string inverters have optimizer, and you put an optimizer below each panel. But look at what happens, say, with the Generac optimizers, and that will give you a good insight as to some of the issues that you can have with optimizers that you don't have with microinverters. And I believe it's the winning technology. It's also the scalable technology. One panel, one tiny box, corollary to one chip, one panel, one chip, and I believe they can grow exponentially as the space of solar energy grows exponentially. Do not forget that solar panels is already the cheapest source of energy anywhere, period. If you want to see, I've done a few videos on that topic, but if you're interested in the topic, you can look at a lot of learned individuals, a major one being Tony Seba. Tony Seba really explains it so well. Let me move on to STEM. STEM is an installer of megapacks. What's interesting is that they install, still the majority of their installs is the Tesla megapacks, which is very interesting. So they're kind of a competitor with Tesla. They compete because they install a lot of Chinese megapacks, which are much cheaper than the Tesla ones, but they also install a lot of Tesla ones. And megapacks are essential to Industry 2.0. They're essential to Transportation 2.0. If you want to have, say, megawatt chargers, a charger where you can charge a truck, an electric truck, in under 1 minute, you're going to have a megawatt charger with one of these cooled cables that can draw a lot of energy. And that energy can't be sustained by the grid. The grid is not built for this. The grid is not going to work for this. You need mega batteries, and that's what STEM does. STEM installs and manages mega batteries, and the money on STEM is in the software and trying to upsell that software that's going to manage those batteries. It's a small cap, much riskier than the other two. Nonetheless, I believe a very interesting company that I've covered multiple times on the channel. Let me move on to my healthcare companies. I used to like Teladoc very much, but Teladoc did a failed acquisition in my view. Livongo was a total waste of shareholder money. Their mental health division is doing okay, I guess, but given how much they've paid for Livongo and what they had promised, they really under-delivered, and I have made a major shift from Teladoc to HIMSS. I sold all of my Teladocs. Now I invest in HIMSS, and I believe in HIMSS for a lot of reasons. Many of my past videos have been on HIMSS. I don't want to go into it too much, but HIMSS deals with a lot of chronic conditions, people that have to come back and keep buying and keep buying and keep buying, and they also focus on conditions that are typically not covered by insurance, and that makes them very agile and able to offer new products really quickly. They're also a compounding pharmacy, which allows them to offer custom products. Anyways, this is not a HIMSS video, but this company has a lot of going for it, and it is the cheapest in my coverage universe right now. This company is extremely cheap despite the recent run that we've had in the stock market. Quite the run. All right, moving on to stocks that I am not adding to right now and that I'm actively considering trimming, at least for a few of these, namely Palantir and MongoDB. They're the data warehousing and the data monitoring stocks. I don't want to go too much into those. If you go back to my Friday videos, I've spent more time discussing them. Each of these have a dedicated video on the channel, but what you need to know is that they handle modern day data and they do different things, right? Palantir does AI on top of its data. MongoDB is a NoSQL database. It's a database that's easy to use that allows you to manage that data. Snowflake is the data cloud. It's storing that data in the cloud, and it allows for easy communication among different companies that want to share data. They have a data marketplace. It's all very interesting, all done in the cloud. And Datadog is monitoring data from infrastructure and spotting issues in infrastructure. Both of them have a niche within the data space, but they're roughly in the data sector. Very expensive sector. A lot of people see the data opportunity as I do. I do too, and that's why they're so expensive right now. Moving on, let me move on to cybersecurity. Cybersecurity kind of stuck in the middle, aside from Cloudflare, which is quite expensive. There's a lot of hype around Cloudflare. It's a tinier position for me, so I don't worry too much. Even if it were to get above a 1, I wouldn't worry too much because it's a small position. Cloudflare is kind of a VPN for website. They protect websites. They hide a website's IP address so it can't be attacked. That's the business model for Cloudflare, ticker symbol NET. And then you have CrowdStrike and Zscaler. I like both of these companies equally. If pressed, I would really choose CrowdStrike, but really most companies get both. Most companies have to get both. You have to get CrowdStrike, the endpoint security system, so that systems do not get infected by attacks. And then you have to get Zscaler, right, so that an attack on a laptop does not spread to the entire company network. Typically, you'll see both of those sold, and that's why I tend to look at those and buy those two stocks in tandem. And their growth, their numbers are all pretty similar in my view. Very, very solid companies. I believe I've made videos on both of those. Let me move on to e-commerce. E-commerce is an old trend. Shopify is very expensive right now. There's a lot of hype around Shopify. Anyways, I find it expensive. I wouldn't be adding to Shopify right now. My favorite is and has long been Mercado Libre. Brazilian company, operates in 4 countries in Latin America. Brazilian is number 1. It's got a lot going for it. It's doing a lot of things that a lot of competitors, including C-Limited, have been trying to do over there in that part of the world and have not succeeded. So Mercado Libre is my favorite e-commerce. Second one is C-Limited. The reason why C-Limited is second is because they have a gaming division. They have issues with their gaming division because India, for example, banned their top game, and so the e-commerce division in Indonesia that they have, Shopee, is doing so well, but it's only covering the decline of Garena. So for now, kind of a trouble stock. My favorite in the space is Mercado Libre. I've made multiple videos about it. Let's talk of the payments space. Not much to say about the payments except that DLocal and Square, I'm in standby. They are both under attack by short sellers. Short sellers are rough, let me tell you. I mean, they can really, reduce your investment returns. Sometimes you get a short seller attack one of your stock, it's down 50%. So that's why I'm not touching those because they're short sellers. Because I know the short sellers, especially those two, those attacking DLocal and Square, are relentless. But aside from that, my favorite in the payment space is StoneCo, pronounced Stonye in Brazil. They are the Square of Brazil. They provide small business with payment solutions easy to handle. Stonye is part of a duopoly in Brazil. Their competitor is PagSeguro. I believe Stonye is a little bit better, but nobody could be faulted for owning PagSeguro, in my opinion. These companies are doing very well, culturally relevant in Brazil, and I like them very much, and I like these prices very much on StoneCo and that stock. PagSeguro is also very cheap. I've covered it on the channel as well, but I own and cover StoneCo typically. Let me move on to my chip stocks, the chip makers. Well, all of these are actually fabless, so they don't make the chips, right? They contract them out to TSMC. But moving on from that, I don't know what to tell you. I don't know what to say. I mean, Nvidia is absolutely crazily expensive. It's tough to see how returns are going to be possible for the next few years. I'd be happy to be proven wrong. But anyway, it's very expensive right now. AMD, I would put in the same boat if it keeps going up. I'm uncomfortable with that valuation for AMD. Keep in mind, these are companies that grow at a lower rate than 20%. It grows less than 20%. So it's getting very close to monetary growth and monetary inflation. So you're just staying afloat, and you're really paying up for each percentage point of growth just to stay afloat. So I am looking to trim AMD. Indie is an outlier. I could have put Indie in my energy revolution stock. Indie is a supplier of ADAS systems to competitors of Tesla. Interesting company, very compelling play. Lots of orders from a lot of smaller players. Riskier stock because they don't sell to Tesla. They sell to a competition. So it's very risky. A competition can quit. Competition can buy from a bigger OEM makers of ADAS and LiDAR systems. So risky stock, risky company. Nonetheless, dirt cheap, especially when you consider the sector that it's in. Pubmatic and the Trade Desk, I don't need to spend much time on it. I find the Trade Desk very expensive. Pubmatic itself is not that cheap for that level of growth. These companies are, in my view, sprung up. They would go up quite a bit if the recession goes away and we have a drop in rates. So I think a lot of traders are setting up those bets right now, so they're a little expensive. Nonetheless, advertising online is a mega trend. It's ad tech. It's here to stay in my view. So over the long run, I believe it's an interesting play. Noteworthy, I do own Google, but I consider Google a bond alternative, kind of a sleeper stock, kind of a cozy stock, not a hyper growth stock. But in the ad tech world, you would definitely add Google in there, and you could make a really strong case when Google is the best buy, especially for the Trade Desk, given that valuation. Very solid company, very great management. Nonetheless, very expensive. Let me move on to my lifestyle stocks. In my lifestyle stock, I have Celsius Holdings. Celsius Holdings is trying to disrupt, coffee to a lesser extent, Monster beverage and energy drinks to a larger extent. And they're doing pretty well. They're doing well with millennials. If you don't live in the US, Know that in the US, their drinks are everywhere. You can't go in the grocery store without seeing a Celsius. That's why you're seeing 67% growth. Very, very popular in the fitness community, very popular among women. People drink that. It's pretty tasty, actually. I've had it a few times. And it's a replacement of caffeine. It's got about 200 milligrams of caffeine in it. So people are really loving Celsius, and it's showing in the numbers. If you're curious about why would anybody want to invest in a beverage company, right? That sounds like a cutthroat business. Beverages, that's awful. Well, I would suggest one looks at the returns of Monster Beverage, which have been absolutely outstanding. The margins on that type of product are really, really good. Your main cost is really transportation and transporting them. And in the case of Celsius Holdings, they have a partnership with Pepsi, which really helps them out. Bigger risk for Celsius Holdings, in my view, is that they could be acquired by Pepsi, but we'll see. The stock on an enterprise value over gross profit number is very expensive, right? But when you adjust for their growth, it's actually middle of the road. It's not that expensive. All right. They move on to a stock that is actually dirt cheap. It is Lovesac. They've reported their earnings. They're kind of flattish, a little up, kind of flat. It's nowhere near the catastrophe that the stock price would imply for Lovesac, right? The market is saying, oh, real estate's dead. People are never ever going to buy furniture. People are just going to get a used lazy boy recliner. I don't believe that. They're trying to disrupt furniture, a space that hasn't been disrupted in 100 years, right? And so they're doing bean bags, they're doing sectionals, they're doing furniture that grows and lives with you. Very interesting company, kind of achieved the design dream. And it's dirt cheap. There is no other way around it. Look at this metric. Enterprise value over trailing 12-month gross profit is a 1. This company is trading essentially lower. Not essentially, it's trading at about gross profit, right? It's like forward gross profit 415 million, it's trading at 486. So this company costs its gross profit, which is insane. I can't imagine how low a stock like this is. But anyways, that's just the way it is. Figs, not doing too well right now. They are kind of going through the overhang of healthcare, is what I'll call it. Healthcare boomed in 2020, 2021. Now healthcare not doing so well, so scrubs are not selling too well. Figs is a seller of scrubs, and they're trying to pull off a Lululemon. What Lululemon did to the yoga pants, Figs is trying to do to the scrubs. And so we'll see if it works or not. It's a bet. We'll see if it works. Definitely higher risk, definitely smaller cap. Let me move on to DigitalOcean. DigitalOcean is a provider of cloud infrastructure, servers for rent, mostly for small businesses, for developers. They have a niche in the sector. This company is fine, middle of the road in my evaluation, doing fairly well. I've covered it on the channel before. Same for AXON. AXON is a provider of police equipment, such as cameras, such as evidence management in the cloud, etc. This is a company that's very niche, but nonetheless, it's had steady growth and should continue to have steady growth. Definitely exposure in one's portfolio that one would be hard-pressed to find anywhere else. AXON, interesting company. I've added these two. I've called them new stocks. I've added them to the lifestyle categories, but they actually belong in entirely different lifestyles. But I am on vacation, so I haven't had time to create another megatrend or reorganize these megatrends. So that's why they're here. Let me move on to neobanks. I love two neobanks. It's Nubank and SoFi. Nubank is in Latin America. They're doing very well. They're dirt cheap. SoFi is in the United States, and it's been doing so well over the past 2 weeks. The new bill for funding the U.S. government that passed has some clear language saying that the student loans will definitely resume within 60 days after the end of a moratorium, and the market is excited about that. And so that's why it's granting in such a high valuation. But we'll see. We'll see. I mean, I don't know what to trust anymore. We'll see if student loans really come back. If it comes back, it's now a small business of SoFi. SoFi pivoted, and it's not the best business. But if it comes back, the market will surely be excited, and we can expect conference call where every single analyst asks about student loans because they recall SoFi as a student loan company. That's just what they know and they remember. But anyways, both companies, you'll note that these companies, over my spreadsheets, over what, 4 months I've been doing these spreadsheets, they trade in line. I mean, it's tough to choose. Sometimes SoFi is cheaper. Other times Nubank is cheaper. It's all a matter of which exposure you want. You know, Nubank is in Latin America. SoFi is in the US. So pick the exposure that you wish in your portfolio. But that's different exposure. Nonetheless, these stocks I think are doing equally well in my view. I will finish with platforms. The only platform I've covered on the channel is Airbnb. Actually, that's not true. I've done a quick video on Fiverr. Only stock I own in there is Airbnb. I think Airbnb is an outstanding company. Airbnb is perhaps the only company that I really like from a quote unquote net margin standpoint. I don't look at that in my channel, but it's true that in the case of Airbnb, not only do they have an outstanding gross margin, but that then turns into really, really amazing net margins. This is a company that's a cash machine. You know, they don't have to invest in their two-sided platforms very much. They're a toll road. It's the sellers of accommodation on the platform that do all of the investment. They have more rooms, more accommodations. They can accommodate more people for the night than all of the hotels existing in the United States put together. That's absolutely insane. Airbnb is a phenomenon, and it is a platform. And platforms are an awesome business model. They're actually one of the best business models out there, along with cybersecurity and data SaaS, software as a service. I believe they're amazing business models. I own Airbnb. I don't own Etsy. I don't own Fiverr. I'm interested in these stocks. I like these stocks. But they are a little, at least in the case of Etsy, a little too expensive. And the growth for Fiverr is too low for me. However, Airbnb I like very much. So, as a conclusion, feel free to pause on the video and look at my calculations and see what you like, what you don't like. Just tell me what you think about this entertainment. This is entertainment and entertainment only. Obviously, as I've made clear, this is not investment advice. I really hope you were entertained. Appreciate all of your likes, all of your subscribes. I miss you all. I'm still on vacation. I will come back with the daily videos as soon as this is over, and I am beginning to really miss this YouTube hobby thing of mine. So anyways, thank you very much. Thank you for watching this entertainment only video. I hope you were entertained, and have a wonderful, wonderful day. Thank you.